TGIF, everyone, as we all know that the Feds have increased the Fed fund rate again. Now, remember, the Fed fund rate is not the interest rate. However, it does directly affect what? HELOCs, right? Credit cards, directly. And then indirectly, it absolutely affects mortgage interest rates. So right now, as far as the Feds are concerned, this is the 7th consecutive hike. And right now, as you can see here, it all started in March. We were at 0 when we were in COVID. And what is the Fed fund rate? Well, the Fed fund rate is what banks are charged to lend out money. So when it was at 0, that's why interest rates were so low. So as you can see here, March, May, June, July, September, November, and now December, that it started out at 0, and now it's at 4.25 to 4.5. The Feds want this Fed fund rate to go up to 5% to 5.25. Well, if the banks are being charged 5% to 5.25, right now it's 4.25 to 4.5, that is why interest rates are going up higher. So again, take a look at your credit cards because your interest rates are directly affected, and so those are going up, right? So when we see this, what is the purpose of the Fed fund increasing the rate? Well, they're trying to control inflation. This is only one tool. I did another video showing there were other tools for them to use, but right now this is the tool that they're really focusing on, right? The biggest thing from what the Fed said now compared to what they said in November is that in November they said, hey, we're going to just keep increasing and increasing and increasing regardless of what's happening. But when the Fed spoke, what they did say was this: hey, we see that the Fed fund hikes are helping with inflation. So although the Fed fund rate is going up, interest rates did fluctuate downwards. Now, how much downward it is will depend on, right, again, your scenario, right? And the way the market is reacting to it. So I wanted to talk to you quickly about, we keep hearing about the market's going to crash, but I wanted to show you the median and the mean home price in the USA. So median is if 100 homes sold, we add it all up, we divide it by 100, okay? The mean sales price has a different way, so it gives you a higher price of what it actually is happening. So in 2000, would you believe the median home price was $165,300? Now again, depends on what zip code you live in, and the mean sales price was $202. So you can see there's a big difference. And as we age in 2000, 2005, 2015, and then in 2020 is when we hit the $329,000 mark, right? So if you look at from 2000 in 20 years, it doubled, almost doubled, right? And then if you look at the mean price, it's at $383,000. Now, if you look at 2022 and you look at first quarter until now, then the median home price is about $428,700. So if you look at 2 years ago, right, that's almost $100,000. It is $100,000, right, of equity growth. But also for people who are trying to get in, that means it costs them that much more, okay? Now, when we look at the mean sales price, obviously it's going to be a little higher, and that's at $480,300. And again, it all depends on the zip code that you are in, right? So when we hear that the market is going to crash and we're seeing some price reductions, it's still considered a seller's market in most areas. And why? We all know that it's all due to inventory, right? The less inventory we have, it is the buyers who are deciding on what the price is that they're willing to pay to get that home, okay? Now, as the interest rates continue to fluctuate, what I recommend is that you stick to your mortgage payment comfort, okay? So what does that mean? So interest rates, right, are going up or fluctuating, then as long as you stick to your budget and say, hey, I want to stick to this mortgage payment, then we'll increase or decrease your purchase price accordingly, right? Because if rates just right now fluctuated a bit down, then your purchase power got up higher, right? So remember, the market is shifting, And so hopefully you can negotiate more than we could in previous markets, right? So when we see the fluctuation in regards to sales prices, do you see a lot of price reductions? So depending on the motivation of the seller will indicate, right, what you can and cannot do. And that's why it's more important than ever, right, to have a realtor on your side to sell and or purchase, because there's a lot of liabilities and because of things that are going on. You want to make sure that you have someone who's negotiating on your behalf, okay? Now, let's talk about 10-year bonds, the mortgage rates, and the mortgage bonds, MBSs, right? Because at the end, it all boils down to, you see how this is at 5.5? Remember, the higher the number this is, the less you pay to get the rate. Now, this is just a coupon. That doesn't mean that's going to be your interest rate, right? But it is possible, depending on where you're at in regards to getting the best rate, and most important, the loan product also dictates what you can get. Now, you also have the S&P, which, as you can see, is going down a little. And then you have the 10-year Treasury, which is now at 3.4. Remember, when rates were really, really low, the 10-year Treasury was at less than 1%, okay? And as we can see with this roller coaster ride, right, this is what's helping us in regards to alleviating. So we're always having these milestones to hit. So when you purchase a property or when you go into the market, you're going to make an offer. Once it's accepted and you have a home, then that's when you can lock your rate. That's when you have a discussion to say, hey, do I lock my rate now? Do I take a chance and hope that I can get a better rate and or better cost? That's what that's all about. So let me know if this is helpful, because at the end of the day, the Fed fund rate, right now is in the 4s, and the Feds want it to be increased up to 5 to 5.25%. The next Fed fund meeting is in February, so we'll see how inflation is affected, and then hopefully they'll make whatever decision they're going to make. But at the end of the day, people who have to buy will buy, and the people who want to sell will sell. And when you are listening to information out there, right, you're going to hear, right, what you want to hear. So if the market is good, you're going to hear all the good information, right? If you think the market is bad, then you're going to gather all that information. I always say, if you are ready, then just go into the market and get what you need. We'll create a plan, so 6 months, a year, 2 years from now, we can do whatever we have to do in regards to refinancing your home and making sure that your mortgage payments go down. Okay? Have yourself a wonderful weekend, and I will chat with you soon.